So guys, in this video, I'm going to talk about risks that we can hide, well, not we, people hide, people who sell strategies, who sell you performance, hide underneath the equity, which can look really nice and can actually be nice, okay? So, in this video, I'm just going to go through potential risks, and I'm also going to talk about the strategy logic. So sit back, relax, and I'll tell you how the strategy works. So this is a futures market, and it pretty much works on, pretty much anything, okay? Now, the logic is really simple, and it's a DCA, okay? So DCA will always show you beautiful equity, and for technical reasons, okay? For the reason the way these programs are built, they show realized equity, okay? And you will see only realized equity on the charts. Now, so the strategy is that simple. Market goes down by a set value of percent that we set. So for instance here, we get a signal that goes down by 0.3%. Inside one candle, okay, we go long in anticipation that the market is going to bounce back and make some profit. And target coefficient in this case is also 0.3%, so 0.3% of this candle here. Okay, so if this falls, excuse me, by 0.3%, on the next candle here we buy it. Same going up. So for instance here, this candle went up 0.3%, we sold and got 0.3% of the candle body back. Now, just for the ease of the example, I'm just going to put this to 0.5% target, so you can see that it's like half of the candle body, right? So see? Now, next, if it doesn't get it, okay, then it's just going to start scaling. And it'll just start scaling in by, so here I got scale step coefficient set to 2. That means 2 more candles go down like that. I want to scale in again, okay? So scales in once, twice, 3 times, as many times as I said to get the money back here. And there's a little offset of 0.1% to position average price. So I put my target to break even plus 0.1%. Of the position average price I want to make so that I get the money back. Now, if you look at this equity, pretty much $19,000. This is 1 year test on a 15-minute chart. Doesn't look too bad, does it? Okay, if you just look at the equity and you just look at the 80% of trades are profitable, 2.2 profit factor sharp. I mean, 0.5 here, but I can do some tests and I can probably push it up to like 1.5. Okay, so hedge fund level, sharp coefficients, everything, right? But let's look at the downsides. So this is a 1 year test, so 365 days. We are on MES, right? So we made $19,000. All right, let's look at our trades. So start trading. Ooh, look at this. Scaling. So the target here was moving until on scaling 11, it finally made it. Okay, that was probably the worst part. Now, so scale in 11 required us 11 scale-ins plus the original position, which is 12. So 12 times 12 positions. Now, 12 positions, the maintenance margin on MES is about 2,700 right now. So $32,000. Let's just round it up to $33,000. This is the amount of money you need to have plus the drawdown, the open equity drawdown, so open unrealized drawdown to maintain this position. Okay, guys, and this is like, I mean, this is like in a, you know, potentially it could have been worse. So we don't know where it ends, right? But you look at the equity, it's beautiful. You think, I'm going for this, all right? You look at that, yeah, but no. So let's look at the place where it went for the 11 scale. So here are the 11 scale-ins. Okay, so that's about in short, and MAE here, that's probably your max drawdown point. Okay, so if we look at the MAE starting from 2,187, so roughly 2,000, 2,000, 4,000, 6,000, 6,000, 7,500, 8,509, 10, 11, 12, 13, let's say roughly 14,000 drawdown. So $33,000 maintenance margin plus 14,000 open equity drawdown. So 47. Okay, let's say you put 50K on your account. So for 50K in 1 year, you would have made 20,000, which is 50,000. Well, I don't know what, 19,000 divided by 50,000. That's 48. That's 40%. 40% you made. That's good, isn't it? Now the real drawdown, not this drawdown that this showing. This is showing 3.3K. But the real drawdown was 14,000 when all of those open trades, right, happened. 14,000 is something. So inside Ninja, they need to make max cumulative MAE, right? Not this closed equity, closed realized drawdown, because that's not really what you need to know, because you would have you can get liquidated, okay? You don't really test like that, okay? So 14,000 divided by 50 that you put your account, that's 28%. So roughly, you made 40% for 30% uncontrollable risk, because, well, obviously the market could have gone against you and against you and against you and against you. I mean, obviously, with DCA, if eventually, you know, if you got enough money, you will get the money back. It's just like how much drawdown are you ready to take? Because you can scale in, scale in, scale in, scale in forever, and you will get it back. Now, so guys, if you want this framework, you want to play around with it, it's available on the website. You can go and get it and see if you're ready to take the risk. Okay, but I'm not selling equity, I'm just selling ideas, I'm selling frameworks, and it's fun to play around with this. Okay, you can run this on any time frame. You can also you know, if you want to maintain the margin, you can. There's a setting here that will close your position at 445, but that will kill your equity completely. You can control your max scale-ins. Live mode is just something to put on and to not run the back test, just go into live trading, okay? But overall, very simple strategy. Shows that DCA works if you're ready for, you know, to take on the drawdown. You know, to sit through this might be a good idea if you, for instance, are going to buy some stocks you like. This is actually a pretty cool idea, right? Because, well, I mean, you don't get, obviously, you will have to put in the money, but you get to hold the stock, you know, and eventually, you know, even if eventually the DCA will work out at some point. It's just like the amount of stock that you'll have to buy, and it's probably better than futures, because the future contract here will also expire. So you got those expiration risks as well there, right? This is a continuous test for 1 year, but again, for the futures contract, there's that as well. So I would probably run this on a stock that I don't worry about holding for a long time, right? So I buy it and then DCA at some point, DCA at some point, DCA at some point, and then just keep it hanging until I turn until I get my pension. All right. So something to think about. Just some ideas that you can play around with when you're bored. Take care.